There's a line that gets repeated in financial circles so often it's become almost meaningless. The Federal Reserve can print dollars. Everyone nods, everyone agrees. But here's the part most people miss. The Fed cannot print silver. And that difference, that fundamental constraint, is about to matter more than it has in over 40 years. Because right now we're living through the largest monetary expansion in human history. Since 2008, central banks globally have created over $25 trillion in new currency. The Fed's balance sheet exploded from $800 billion to over $8 trillion at its peak. Money supply grew faster in 2 years than it did in the previous 2 decades. And the assumption, the quiet assumption everyone makes, is that this can continue indefinitely. That dollars are infinite. That liquidity is a policy choice, not a physical constraint. But silver exposes the lie. Because while the Fed can create dollars with a keystroke, it cannot create an ounce of silver. Not one atom. And in a world that's electrifying everything from vehicles to grids to data centers, that constraint is becoming a problem. A big one. Let me show you why this matters right now. Not in theory, not eventually. Right now. The dollar is a promise. A Federal Reserve note is a liability of the central bank, backed by confidence, by economic output, by the belief that tomorrow it will buy roughly what it buys today. But that belief requires maintenance. And when the supply of dollars grows faster than the supply of goods and services, the value of each dollar falls. This is not controversial. This is arithmetic. Since 2020, the money supply, measured by M2, increased by over 40%. 40% in less than 3 years. During the same period, goods production increased maybe 2%. So you have 40% more dollars, chasing roughly the same amount of real things. The result? Inflation. Not the gentle 2% target the Fed likes to talk about. Real inflation. The kind that shows up in grocery bills, rent, energy costs, and the price of everything that matters. The official response was predictable. Raise interest rates, tighten policy, signal credibility, and it worked, sort of. Headline inflation came down from 9% to around 3%. But here's what didn't happen. The money supply didn't shrink, it stabilized. The $6 trillion that was created is still out there, sitting in the system, looking for assets to flow into. And that's where silver enters the picture. Because when currency loses purchasing power, people don't just hold cash and watch it melt. They move into assets, real estate, stocks, commodities, things that can't be printed. And throughout history, when monetary confidence cracks, precious metals have been the default escape valve. Gold gets the headlines, but silver does the work. Here's the thing about silver that separates it from every other asset. It's both a monetary metal and an industrial commodity. Gold is mostly financial. It sits in vaults, it backs currencies, it gets held as insurance. But silver gets consumed, used up, turned into solar panels, electronics, batteries, medical devices, defense systems. And once it's in those products, it's gone. Not recycled, not recovered, just gone. The solar industry alone consumed over 200 million ounces of silver in 2024. That's roughly 20% of total annual supply. Electric vehicles use 3 times the silver of traditional cars. 5G infrastructure, AI data centers, grid modernization. Every major technological trend of the next decade is silver intensive. And none of it stops just because supply gets tight. This is where the Fed's printing press becomes irrelevant. Because you can print dollars to stimulate solar deployment. You can print dollars to subsidize EV production. You can print dollars to fund infrastructure. But you cannot print the silver those projects require. And when demand exceeds supply, price is the only mechanism that clears the market. Now, some of you are thinking, okay, but markets adjust. If silver gets expensive, supply increases, mines open, problem solved. Except that's not how silver works. And this is critical. Silver is rarely mined on its own. About 72% of global silver production comes as a byproduct of mining other metals. Copper, lead, zinc, which means silver supply doesn't respond to silver prices. It responds to copper prices, to zinc prices, to the profitability of base metal mining. And right now, base metal mining is not expanding. It's contracting. Why? Because new mines take 7 to 10 years to develop. Because environmental regulations are tightening. Because ore grades are declining. Because capital is expensive and permitting is a nightmare. The global mining industry is not positioned to significantly increase silver output, regardless of price. And this creates a structural deficit that money printing cannot solve. Let me put some numbers on this. In 2023, total silver mine production was approximately 830 million ounces. Total demand was around 1.2 billion ounces. That's a deficit of 370 million ounces. Where did that deficit come from? Above ground inventories, stockpiles, reserves held by governments, institutions, and exchanges. And those stockpiles are draining. The COMEX, the primary futures exchange for silver in the United States, holds registered silver that's available for delivery against contracts. As of late 2024, registered inventories sat at roughly 50 million ounces. That sounds like a lot until you realize global industrial demand alone is 680 million ounces annually. The COMEX holds about 3 weeks of industrial consumption. 3 weeks. If even a small percentage of futures contracts demanded physical delivery, the system would break, not gradually, immediately, because the silver isn't there. The paper market, the world of futures contracts and ETFs and derivatives, is vastly larger than the physical market. Estimates suggest paper claims exceed physical silver by a factor of 50 to 1 or more, meaning for every real ounce of silver, there are 50 claims on it. This works fine as long as nobody asks for delivery, as long as participants are content with cash settlement. But history shows that when confidence in paper promises erodes, everyone wants the real thing at the same time. And when that moment comes, the gap between paper and physical becomes violently visible. We've seen this before. In 1980, the Hunt brothers accumulated roughly 200 million ounces of physical silver. That was about 1/3 of U.S. supply at the time. Silver went from $6 to $49 in 18 months. The exchanges changed the rules mid-game, banned new long positions, forced liquidation. The market crashed. But here's the key. The shortage was real. The price spike was justified. It took rule changes to stop it. Now imagine a scenario where the buyer isn't two reckless billionaires, but a nation-state, or a consortium of industrial users who realize just-in-time procurement is no longer viable, or a major bank that's been quietly accumulating for over a decade. What happens when the entity holding the physical silver is also deeply embedded in the financial system itself? JPMorgan Chase reportedly holds close to 1 billion ounces of silver. If accurate, that's roughly 9% of all above-ground silver, more than any individual nation, more than any ETF, more than the Hunt brothers ever dreamed of. And unlike the Hunts, JPMorgan isn't fighting the system. They are the system. They help set the rules. They operate the warehouses. They clear the trades. They have perfect information. This is not conspiracy. This is market structure. And market structure determines outcomes far more than sentiment or fundamentals. Because when you control the infrastructure, when you control the warehouses where metal is stored, when you control the clearing mechanisms, you don't need to manipulate prices directly. You just need to understand where the leverage points are. And silver's leverage point is physical supply. The Fed can print dollars to bail out banks, to buy bonds, to inject liquidity. But the Fed cannot print silver to bail out solar manufacturers, electronics producers, or defense contractors when supply runs short. That constraint is absolute. And as monetary expansion continues, as inflation remains elevated, as confidence in paper assets wavers, that constraint becomes the dominant variable. Let's talk about what happens when industrial users start competing with investors for physical metal. Because that's the scenario we're entering. For decades, industrial demand and investment demand existed in separate lanes. Industry bought what it needed. Investors speculated on price. The two rarely collided because supply was adequate. But structural deficits changed the game. When available supply shrinks year after year, when inventories fall to historic lows, when delivery delays extend from days to weeks to months, industrial users panic. They stop buying spot. They start locking in long-term contracts. They start paying premiums for guaranteed delivery. And when industrial giants start competing for supply, small investors get priced out. Not because they can't afford the metal, because they can't access it. We saw glimpses of this during COVID. In March 2020, silver fell to $12 per ounce on paper. But try buying physical coins or bars. Premiums spiked to $10, $15, even $20 over spot. Dealers were sold out. Mints suspended production. The disconnect between paper price and physical availability was stark, and that was a brief disruption. Imagine that dynamic becoming permanent. This is where understanding the difference between the Fed's power and physical reality becomes essential. The Fed can lower interest rates to make borrowing cheaper. It can buy assets to support prices. It can provide liquidity to prevent cascading failures. But it cannot create supply where none exists. And silver supply is constrained by geology, by mining economics, by refining capacity, and by time. None of those respond to monetary policy. Another angle that's underappreciated is the geopolitical dimension. Because silver, like many critical materials, is not evenly distributed. The largest producers are Mexico, China, Peru, Australia, and Russia. Notice anything? Not exactly a list of stable, politically aligned nations. And as trade fragmentation accelerates, as sanctions become normalized, as resource nationalism rises, access to silver becomes a strategic vulnerability. China understands this. Reports indicate that starting January 2026, China may tighten export controls on refined silver. Not a ban, just quotas, licensing requirements, prioritization for domestic users. And because China is embedded in global refining and processing, even silver mined elsewhere often passes through Chinese infrastructure on its way to end users. If those controls take effect, Western manufacturers will face higher costs, longer delays, and increased competition for available supply. And the Fed's printing press won't solve that problem. You can't print your way out of a supply chain choke point controlled by a geopolitical rival. Let's shift to the investment side for a moment. Because while industrial demand is the structural driver, investment demand is the accelerant. When inflation persists, when real interest rates are negative or barely positive, when currency debasement is policy, tangible assets become appealing. And silver, unlike gold, is still affordable for average investors. Gold trades above $2,700 per ounce. That's a significant entry point for many people. Silver trades around $30. You can buy meaningful exposure without breaking the bank. This accessibility means that when sentiment shifts, when retail investors decide they want protection, silver sees disproportionate inflows. And because the market is relatively small, those inflows move prices quickly. Total annual silver supply is roughly 35 billion. For context, that's less than the market cap of many individual tech stocks. It's a rounding error in global bond markets, which means it doesn't take massive capital flows to move the silver market significantly. A few $1 billion entering over a short period can overwhelm available supply. This happened in 2021 during the Reddit-driven silver squeeze. Retail investors coordinated to buy physical silver and shares of the SLV ETF. The goal was to expose the gap between paper and physical. And while the squeeze ultimately fizzled, it revealed something important. The system is fragile. Inventories are thin, and even disorganized retail pressure can cause stress. Now imagine organized institutional demand. Pension funds allocating 2% to commodities. Sovereign wealth funds diversifying out of dollars. Family offices seeking inflation protection. That's not speculative retail flow. That's structural, sticky, long-term capital. And when it enters a market with declining inventories and structural deficits, prices don't just rise, they gap. Here's where we connect back to the Fed. Because the Fed's policies over the past 15 years have created the conditions for this outcome. Ultra-low interest rates encouraged debt accumulation. Quantitative easing inflated asset prices. Pandemic stimulus flooded the system with liquidity. And all of it was built on the assumption that inflation was dead, that velocity would remain low, that money could be printed without consequence. That assumption is now being tested, and silver, more than any other asset, exposes the flaw in the logic. Because you can suppress interest rates, but you can't suppress geology. You can print currency, but you can't print conductivity. You can manipulate paper prices, but you can't manipulate physics. Silver's unique properties make it irreplaceable in key technologies. Its conductivity, both thermal and electrical, is unmatched. Its reflectivity is essential for solar panels. Its antibacterial properties make it critical in medical applications. And while researchers continuously explore alternatives, performance trade-offs, cost increases, and engineering challenges limit substitution at scale. This matters because as electrification accelerates, silver intensity increases. The average EV uses roughly 25 to 50 grams of silver. The average solar panel uses 20 grams. 5G base stations, AI chips, grid infrastructure, all silver intensive. And projections showed demand in these sectors doubling or tripling over the next decade. Meanwhile, supply is stagnant or declining. The math doesn't work, and no amount of monetary policy can change that. The Fed can make dollars cheaper. It can make credit easier. It can stimulate demand, but it cannot stimulate supply when the constraint is physical, not financial. Let me give you a scenario. It's 2027. The US government is pushing hard on renewable energy targets. Subsidies flow, projects get approved, deployment accelerates. But silver prices have spiked to $80 per ounce because supply hasn't kept pace. Solar manufacturers face a choice: eat the higher costs and destroy margins, pass them on and slow deployment, or delay projects entirely. What does the Fed do? Print more dollars? That just makes inflation worse. Lower rates? That inflates everything else without adding an ounce of supply. The traditional tools don't work, and this is the core insight. Monetary policy is effective when the problem is demand or liquidity. It's useless when the problem is physical scarcity. Some argue that higher prices will solve the problem by incentivizing new production. And to a degree, that's true. But the lag is measured in years. A mine permitted today doesn't produce silver until 2032 or later. Refiners can't expand capacity overnight. Recycling rates can't double instantly. The supply response is slow, while demand continues accelerating. This temporal mismatch is what creates price spikes. Because markets have to clear in the present, not the future. And when present supply is insufficient, price rises until demand is rationed. That's not manipulation. That's economics. Another overlooked factor is the role of ETFs in physical-backed products. Funds like SLV, PSLV, and others hold hundreds of millions of ounces as backing for shares. When investors buy shares, the fund is supposed to buy physical silver. When they sell, the fund can sell metal. But during periods of intense demand, the fund's ability to acquire metal matters. If physical supply is tight, the fund faces delays or premiums. If the fund can't source metal quickly, the share price can decouple from spot, trading at a premium. This creates arbitrage opportunities, but also signals stress. And if enough investors demand redemption in physical metal rather than cash, the fund could face delivery challenges. These are not theoretical risks. They're documented in prospectuses as potential scenarios. And in a market with declining inventories and rising demand, they become more likely. When paper claims exceed physical availability, someone doesn't get paid. And figuring out who that someone is happens through price discovery. Often violent, disorderly price discovery. History offers lessons here. In every commodity where paper markets outgrew physical supply, the correction was swift and brutal. Oil in the 1970s, natural gas in the early 2000s, palladium in 2000, rhodium in 2008. The pattern repeats. Long periods of stability, followed by sudden dislocations when the gap between paper and physical becomes untenable. Silver is currently in the stability phase. Prices have been range-bound for years. Volatility is low. Complacency is high. But beneath the surface, the imbalances are building, inventories draining, deficits widening, industrial demand accelerating. And the Fed, for all its power, is irrelevant to these dynamics. Let me address the counter-argument. Some say technology will solve this. New mining techniques, better recycling. Substitutes. These are all real possibilities over the long term, but long term doesn't help when the shortage is now. When projects are being delayed because supply is unavailable, when manufacturers are bidding against each other for scarce metal, technology might reduce silver intensity per unit over time, but if the number of units being produced is growing faster, total demand still increases. Solar efficiency improves, but panel deployment is doubling. EV silver content might drop, but EV sales are tripling. The net effect is still rising consumption. And recycling, while helpful, is limited. Silver in electronics often exists in trace amounts that are economically unrecoverable. Solar panels lock silver away for 25 to 30 years. By the time they reach end of life, the silver inside is often landfilled because extraction costs exceed value. Recycling rates of 15% to 20% are common, but far below what's needed to offset declining mine output. So the narrative that technology will save us is comforting but incomplete. Technology is part of the solution, but it operates on a timeline that doesn't match the urgency of current deficits. And markets don't wait for solutions to arrive. They price the reality they face today. Another dimension worth exploring is the monetary aspect directly. Throughout history, silver has functioned as money. For thousands of years, it was the primary medium of exchange for ordinary people, while gold was reserved for large transactions and the wealthy. The US dollar itself was once defined as a specific weight of silver. And even after fiat currency replaced metal-backed money, silver retained monetary properties. During periods of currency crisis, hyperinflation, or loss of confidence, people revert to precious metals, not because they're primitive or nostalgic, but because metals are no one's liability. They don't depend on a government's promise or a central bank's credibility. They exist physically, and their value is recognized universally. This is why central banks hold gold, not silver, interestingly, because gold's higher value density makes it more practical for reserve purposes. But silver performs a similar function at the individual level. When currency loses purchasing power, silver preserves it. When systems break, silver remains liquid. When trust collapses, silver still trades. And right now, trust is fraying. Not catastrophically. Not yet. But the cracks are visible. Inflation remains elevated despite rate hikes. Deficit spending continues unabated. Political polarization makes fiscal discipline unlikely. And global dollar dominance is being challenged by BRICS nations, by digital currencies, by declining reserve currency share. The Fed's ability to print dollars only matters if those dollars are accepted, if trusted, if perceived as stable stores of value. And when that perception weakens, which it is, the constraint on printing silver becomes the advantage, because the Fed can't debase what it can't create. Let me tie this together. The Fed can print dollars. Central banks globally have proven they will print as much as needed to prevent systemic failure. But printing has consequences: inflation, currency weakness, loss of purchasing power, and those consequences push people toward real assets. Silver stands at the intersection of two massive trends: technological demand driven by electrification and monetary demand driven by currency debasement. Both are accelerating. Both are structural, not cyclical. And both are colliding with constrained supply that cannot respond quickly. The result is a market that is far more fragile than most participants realize, because the system has been built on the assumption of abundance, of liquidity, of paper markets functioning smoothly. And when those assumptions break, when physical reality reasserts itself, repricing happens fast. This is not about predicting $100 silver tomorrow or claiming the sky is falling. This is about recognizing that the conditions for significant repricing are in place. Structural deficits, declining inventories, accelerating demand, geopolitical fragmentation, and a monetary system that has lost the ability to self-correct without creating new problems. For investors, the question is not whether to panic, but whether to prepare. Because preparation is not about timing the exact moment of dislocation. It's about acknowledging that dislocation is more likely than not and positioning accordingly. Holding physical silver eliminates counterparty risk. Holding it before stress becomes obvious eliminates the premium spike. Holding enough of it ensures the allocation matters when repricing occurs. And here's the thing about enough. It's personal. It's based on your exposure, your risk tolerance, your time horizon. But it's not 1% or 2% of a portfolio. Those allocations might provide psychological comfort, but they don't move the needle financially when the asset doubles or triples. Historical periods of monetary stress saw metals allocations of 10%, 15%, even 25% among those who preserved wealth. The people who survived currency collapses were not the ones with token exposure. They were the ones who recognized the constraint before it became obvious, who held enough real assets to offset the losses in paper ones, who understood that systems built on infinite currency creation eventually collide with finite physical reality. The Fed can print dollars, but it cannot print silver. And in 2026, as deficits widen, as demand accelerates, as inventories drain, that constraint is going to matter more than it has in decades. Not because silver is magic, but because physics, geology, and supply chains don't care about monetary policy. They operate on different rules. And when those rules collide with financial assumptions lose. This is the moment when that constraint transitions from theoretical to practical, from something people discuss in the abstract to something manufacturers, investors, and governments are forced to navigate in real time. And when that happens, the people who understood the difference between what the Fed can print and what it cannot will be the ones who positioned correctly. Because this isn't about outsmarting markets or predicting crashes. It's about recognizing structural limits and acting before those limits become binding constraints. Now, if this analysis resonated, you need to understand the next layer, because supply constraints don't exist in a vacuum. They're created and exploited by those who control the flow of metal itself. And when you look at who actually controls silver, not just mines it, but refines it, stores it, trades it, you realize the game is far more concentrated than most people know. That's why you need to watch the next video on this channel. It's called Who Really Controls the World's Silver? And it breaks down the structural traps, the gatekeepers, and the single institution holding nearly 1 billion ounces. Because understanding the constraint is step 1. Understanding who benefits from that constraint is step 2. And that video will show you exactly how the real power in silver operates behind the scenes, why the physical market is on the edge, and what happens when the gap between paper and reality finally closes. Go watch it now. Because the people controlling this market aren't waiting, and neither should you.